Welcome to the Deep Dive Talk Tickers edition. Today we're digging into a really fascinating earnings call from October 30th, 2025, the joint Tex Corporation and REV Group announcement.
Yeah, fascinating is one word for it. Contradictory might be another.
Exactly. On one side, you had some genuinely stellar financial numbers, right? But on the other, this huge merger and restructuring news that just sent the stock tumbling.
Immediately, down about 17% intraday, which is, a pretty severe reaction.
So we've got the earnings transcript, the notes, analyst takes the whole pile. Our job today is to figure out why. Why did the market react so negatively?
It really flew in the face of management's narrative. They were talking up solid financial performance, but investors clearly saw something else, or maybe just too much risk.
Okay, let's start with those financials then, because for the reporting company TechX, they actually looked quite good on the surface.
They did, especially the earnings per share.
Adjusted EPS came in at $1.50. That really smashed the consensus estimates. Weren't they down around $1.21 or $1.22?
Yeah, way down there. So a huge beat on the bottom line. Normally, you'd expect a pop on that alone.
And it wasn't just accounting tricks, right? The cash flow is strong, too.
Incredibly strong. Free cash flow conversion was, get this, 200%.
200%. Wow.
Yeah. So for every dollar of profit they reported, they actually generated $2 in cold, hard cash. That's about $130 million in FCF for the quarter. That usually points to a really healthy operation.
Okay, so earnings beat, cash flow, fantastic. Where did the wheels start to come off then, even before the big merger news dropped?
Well, you started to see hints of concern on the top line, and maybe more importantly in the forward-looking indicator.
Revenue and bookings.
Exactly. Revenue grew, sure, 14.4% year over year, which sounds decent, but it actually missed the street's expectations slightly. Came in around $1.39 to $1.4 billion against a $1.41 billion consensus.
It's a slight miss, okay. But the bookings?
That was the bigger flag, I think. Bookings were pretty soft, only about $1 billion. That gives you a book-to-bill ratio of just 72%.
Oof, 72%. So for every dollar of product they shipped, they only booked 72 cents in new orders.
Right. That's a clear signal that demand is slowing down, at least in the near term.
And that's the moment they chose to announce this massive, complicated merger and restructuring.
Precisely. You see the soft bookings, and then bam, here's this huge strategic shift. You can see why the market might get nervous.
Okay, let's dive into that main event then. The merger. Tex and REV Group. What's the structure?
It's a definitive agreement, stock and cash deal. They're aiming to close it in the first half of 2026.
And the ownership splits.
Existing Tex shareholders get 58% of the new combined company, and REV Group shareholders get the remaining 42%.
How does that 42% break down for RVG holders?
They get a mix, $8.71 in cash per share, plus just under 1 share of Tex6, 0.9809 Tex shares, to be exact. That works out to roughly $425 million in cash going out to those REVG shareholders.
So what's the big idea behind putting these two together? Scale.
Scale, definitely. But also specialization and, maybe crucially, trying to build a more stable, less cyclical business.
Okay.
The combined company will have an implied enterprise value around $9 billion, give or take. And they're looking at pro forma sales, before synergies, of about $7.8 billion based on 2025 numbers.
Yeah.
It creates a really large player focused on specialty equipment, mainly in the U.S.
And synergies are always a big part of these deals. What are they promising?
They're targeting at least $75 million in annual run rate synergies by 2028.
$75 million. Is that achievable?
Well, they say it's a net target. That's important. It means they've supposedly factored in the costs of integration, restructuring, maybe some business overlap that cancels out savings.
So $75 million after all the messy bits.
That's the claim.
Yeah.
And they expect to get about half of that, maybe $35, $40 million within the first 12 months after closing.
That seems fast.
It does. It adds to that execution risk we talked about. But let's look at the strategy for a second. Why merge these two? You mentioned less cyclicality.
Right. How does combining them achieve that?
It's about shifting the portfolio mix. Post-merger, they're saying almost 60% of the revenue will come from what they call resilient essential services.
Like what?
Think fire trucks, ambulances, garbage trucks, the environmental solutions segment. Thinks municipalities and essential services have to keep buying, even in a downturn.
Okay. So less exposure to, say, construction booms and busts that hit the rental equipment side harder.
Exactly. They're deliberately trying to trade some of that cyclical upside potential for more stability and predictability,
Right.
less reliant on those big capital expenditure cycles for construction or general rentals.
And that lets them target better financials.
That's the plan. They're aiming for mid-teens adjusted EBITDA margins once the synergies kick in and after they complete the other big piece of news.
Right, the Ariel's divestiture. Let's get to that. They also want to keep the balance sheet looking solid.
Yeah, they expect leverage to be around 2.5 times pro forma debt to EBITDA at closing, which is generally seen as manageable.
Okay, so merger announced, synergy targets out there, aiming for stability. And then, at the same time, they announced they're immediately looking to get rid of the Ariel's business.
Yes, the part that makes cranes, lifts, that kind of equipment. They're planning a potential sale or maybe a spinoff.
Why dump it now? Doesn't that just add complexity?
It absolutely adds complexity,
Yeah.
but the rationale is that it just doesn't fit the new, stable, essential services model. Aerials are highly cyclical, very tied to those construction and rental markets they want to de-emphasize.
So get rid of the cyclical anchor, basically.
Pretty much. And focus on the segments with better margins, like environmental solutions you mentioned. That 18.3% adjusted operating profit in Q3, that's the kind of number they want more of. Utilities is another strong area for them.
Does management think they can get a good price for Ariel's right now?
They put a positive spin on it.
Yeah.
They argued the brand is strong, performance is well documented, and maybe recent anti-dumping rulings in North America and Europe make a domestic player like this more attractive.
Okay, so they're formally starting that sale process immediately.
Yep, while integrating the merger. See the challenge?
Yeah, definitely. It's juggling multiple chainsaws. What about the growth story for the remaining business, the NewCo?
They painted a pretty bright picture there, especially for the utility segment. Think bucket trucks, digger derricks.
What's driving that?
Two big things. The massive need to upgrade the U.S. power grid and the build-out required for all these AI data centers. Both need huge amounts of electricity infrastructure.
Right, those are genuine long-term tailwinds.
Absolutely. Industry forecasts are talking 8% to 15% annual CapEx growth in that power grid space through 2030, plus general global infrastructure spending.
So if you lay it all out, strong earnings, clear strategic pivot to stability, shedding cyclicality, leaning into growth trends like grid upgrades, it sounds logical. So why, again, the massive 17% stock drop?
Execution risk.
Yeah.
Pure and simple. Or maybe not so simple, actually. It's multifaceted.
Okay, break it down. What are the biggest worries?
I think there are three main buckets of skepticism. One, can they actually integrate these two huge companies smoothly and hit that $75 million synergy target on schedule? Mergers are hard.
Very hard. What's two?
Two, can they keep margins improving or even stable while all this integration chaos is happening? It's easy to lose focus on the day-to-day operations.
And three must be the Ariel's exit.
Exactly. Three, can they actually sell Aerials cleanly and for a good price? Or will they be forced into a spinoff? Investors worry a spinoff might trade poorly initially, basically diluting the value unlock they're hoping for. Plus, managing a sale or spin is a huge distraction.
So it's the sheer amount of stuff they're trying to do all at once.
It's a massive drain on management bandwidth. You just finished a big ESG integration. Now you're merging and selling off a major division. That's asking a lot.
Is there anything on the positive side of the ledger from the merger besides the strategic fit? Any immediate benefits?
Well, the REVG side does bring a very large and reportedly high-quality backlog.
Right. How big?
The specialty vehicle segment, so fire trucks, ambulances, etc., has a $4.2 billion backlog. The total company backlog is $4.5 billion.
And that gives them revenue visibility.
Significant visibility. The average duration on that backlog, especially for fire and ambulance, is like 2 to 2.5 years.
And you said high quality, meaning good margins locked in.
That's the report.
Yeah.
Apparently, a good chunk of that backlog was booked during the recent period of strong pricing, so it should have healthy margins built in, providing a cushion for the next couple of years.
Okay, that's a definite plus. Anything else? Digital, maybe?
Yeah, there's a potential digital upside.
Yeah.
They have this platform called Third Eye that's used in garbage trucks now, safety, optimization, that sort of thing.
Okay.
They plan to extend that into the emergency response vehicles from REV Group. If they can do that effectively, it could create new revenue streams and make the product stickier, maybe improve safety for first responders.
Interesting angle. But even with that backlog and digital potential, they still have headwinds, right? Didn't they mention tariffs?
They did. They reiterated full-year guidance, which still includes a pretty hefty tariff headwind. About 7.70 cents per share, they said. So another challenge to manage on top of everything else.
Okay. Let's switch gears. It's time for our This Is Not Financial Advice segment. Purely hypothetical, intellectual exercise. We pitch an outrageous but plausible trade to our imaginary investment committee.
All right, well, the market's already given us the theme, hasn't it? That 17% drop is screaming doubt about execution.
So the trade leans into that skepticism.
Exactly. It's basically a bet against management's ability to juggle all these balls successfully, at least in the near term.
Okay, lay out the pitch.
The pitch is to consider a short position on the combined entity over, say, the next 12 to 18 months.
Shorting it. Why?
The rationale is bandwidth strain and complexity. We already saw a slight revenue miss, hinting at maybe some demand issues, but the core bet is that executing this massive merger, hitting those aggressive $75 million net synergies, while simultaneously trying to divest a multi-billion-dollar cyclical business like Aerials, it's just too much, too fast.
So you're betting something slips. Integration hiccups, delays, maybe the Aerial sale gets messy or fetches a lower price.
Precisely. You bet that the synergy timeline slips, or the costs are higher than expected, or that the Aerials exit creates more noise and maybe even value destruction through dilution or a poor spin-off valuation, rather than the clean value unlock they're promising.
So the idea is the stock drifts lower as these operational challenges bubble up over the next year or so, even if the long-term strategy makes sense on paper.
Yeah, it's a wager on short-term complexity, overwhelming competence. The long-term story might be fine 5 years out, but the path from here to there looks potentially very bumpy. That 17% drop might just be the start if they stumble.
An interesting, if definitely risky, hypothetical trade. Betting against complexity.
Outrageous but plausible, as the segment says.
So wrapping this all up for you, the listener, what did we see here? A really strange mix.
A fantastic EPS beat, really strong cash flow generation.
Paired with this massive strategic shakeup, merging with REV Group, trying to pivot towards stable, essential services, and simultaneously kicking the cyclical Aerials business out the door.
But the market's immediate reaction wasn't applause. It was fear. Fear driven by that execution complexity and maybe nudged along by the revenue miss and soft bookings.
So the big question you need to ponder is this. Is the underlying strength real? Does that huge high-margin backlog from REV Group, combined with the long-term tailwinds from grid upgrades and essential services, ultimately mean the stock was undervalued before this, or maybe even after the drop?
Or is that 17% discount the market just slapped on it actually a fair price, maybe even still too high for the very real risks involved in pulling off such a complex merger, integration, and divestiture all at the same time?
Lots to think about there. That's it for this deep dive.